Welcome back to the Brent Bruce Daily for November the 21st, 2022. It is now 2:40 p.m. Central Time, and I need to get you updated on what is going on and what to expect for this week. So, first of all, what to expect for this week. This is obviously a holiday week with the Thanksgiving holiday coming up. So, Thursday, the bond market will be closed. There'll be no report. Friday, the bond market is closing early, which means that it will close at 1 o'clock p.m. Eastern Time, which gives us a shortened day on Friday as well, which means that most of the reports are pushing their data into Monday, Tuesday, Wednesday of this week. Not a whole lot coming out, but we do have the minutes from the last Federal Reserve meeting coming out on Wednesday. I think that we've already got a pretty good feel for where they stand on things. We've heard from multiple of the members of the Federal Reserve recently, kind of helping us to understand what their thinking is. So I don't think those minutes are really going to be market moving, but let's take a look and see where we are on the charts and with our Brent Bruce Daily Home Loan Interest Rate. So first of all, you can see here that we're down 14 basis points on the mortgage-backed security. Not really a tremendous move, but not what we want to see. Let's go down to the chart here and look at the technicals. The technical indicators right now are kind of ruling the day. They're controlling things because we haven't had much data over the last few days to push us one way or the other. So look how clearly defined this Fibonacci level is and how we've been fighting with this up and down over the past few days, really the past week after this huge run-up day that we experienced the other day. So you can see that we broke above the Fibonacci level for a brief moment, got pushed back down. Today, broke above it, got pushed back down. So we really don't have anything that is giving us enough momentum to push above this Fibonacci level for a prolonged period of time. And I mentioned that to you last week that we wanted to see us close convincingly above this Fibonacci level in order to allow it to become a floor of support instead of the ceiling that it is acting as right now. So that's where we are right now on the mortgage-backed security. The 10-year Treasury is almost an identical situation where we're not having anything move it really one way or the other. I mean, we're only up one on the day and really just battling, or actually luckily staying below this ceiling of resistance, because on the 10-year, we want this number to go down. On the mortgage-backed security, we want this number to go up. So here, we're now at 3.829. Again, still convincingly below that 4%, which you know is my pet peeve. I don't want to go above that 4.0. And luckily, this 50-day moving average is acting as a pretty strong ceiling for us, hopefully going to push us back down here and allow our 10-year Treasury to improve and the yield on that to come down, which would be helpful to us. So let's take a look and see where we are on our Brent Bruce Daily interest rate. So I went ahead and added another scenario here because it's becoming really just a nice thing to see that FHA, USDA, and VA are convincingly at this point in the fives. A lot of people, buyers, are thinking, look, I have no interest in buying a property with a 7% interest rate. Well, what I want you to understand is that FHA, VA, and USDA, I'm going to go ahead and run that first. Okay. So if someone has even as low as like a 680 FICO score and they want to put 3.5% down on an FHA loan right now, I would be able to offer, I'd have to look at their scenario specifically, but in general, a 680 FICO score, 3.5% down, I am offering a 5.75% interest rate with no points. Okay, so you need to pass that along to your buyers. We are convincingly in the fives on government loans. USDA, 0 down loan, and we can potentially do something at a 5.75% interest rate. All right, so definitely want to get that information out there. Let's open this up and see what if you were to maybe even pay a point. Well, you can get to about 5.5 if they want to pay about a point. That's 0.96. So 5.5, I mean, the mid fives on an FHA loan right now. Unbelievably better than where we were before. Let's take a look at our conventional Brent Bruce Daily 30-year fixed, very well qualified client that we follow each day. Let's go in here and run this scenario. All right. Okay. So we've been about this 6.5 to 6.375 for probably about a week, right? Here we are again, 6.5%, a little bit less of a credit. Remember, we were closer to 800 on Friday. We're at 472 now. What's it going to cost for us to get down to 6.375? $767. You remember last week I had talked about that we were able to get to that 6.375 for like $87 or $83, something like that. So you can see that this move here, the last few days of having, losses, small losses, but still losses on our mortgage-backed security, this has now added up to about an $800 difference in the cost of a 6.375% interest rate. Now, here's something that you need to pay attention to. What if your seller is willing to help out with closing costs? Or what if your buyer is willing to pay a point? Like they have some more money, they can go ahead and pay 1%. On a conventional 30-year fixed, well-qualified client, we are now at a position where for 1 point, we're at 5.999. Okay, so we are in the fives with 1 point on a conventional loan. Now, at one point, I was talking about 7.25%. So in this scenario, that principal and interest payment was $24.56. Now we're talking about $21.58. Okay, so what is that? A $300 difference in monthly payment. So the mortgage payment for your customer today could be as much as $300 less on a $480,000 purchase price if they're willing to either pay a point or the seller is willing to pay a point to get their interest rate down to that 5.999. So just for you to start thinking about how we can start talking to our sellers and our buyers about using discount points or buy downs, things like that. I have all those products, but we are in a position where we can start to allow our buyers to again feel comfortable pulling the trigger on a transaction because we're starting to say the psychological number of we're in the fives. In general, historically, people stop wanting to finance property when you get out of the fives. It's just something in their head. When you get above the fives into the sixes and sevens, it creates a tremendous slowdown historically. If you look at charts of buying patterns. So now that we're able to start offering ways to get into the fives, government loans, no problem at all. FHA, USDA, and VA. And on conventionals, by paying a point, either the seller or the buyer paying a point, we're able to talk about the fives again, which is that psychological number that most buyers now start to feel comfortable moving forward with. It also shows us moving in the direction that I've been talking about, my projection of getting into the high fours in the first half of next year. That's where we are right now. Let me know if you have any questions, thoughts. Make sure you like, subscribe, and share, and I will talk to you again tomorrow.